Well, hello everyone. This is the next episode of The Cut. We've actually got two additional, one guest and my colleague from the Perth office, Bob Jacobs from the Auxilium Partnership. We're here to talk to Luke Furler, who is the head of the Asia Pacific region for Quantuma, and discuss what he's seeing in the Asia region. And today we're just going to talk through the experiences of what he's seen in recent time. And Bob, Luke, how are you?
Yeah, good afternoon, Simon. I think Luke and I are in the same time zone, aren't we?
We are. Yes.
Yeah.
Hi, Simon. Hi, Bob.
Yeah, but we might just kick off with you, Bob, because we formed an alliance a few months ago, and it's well known now out in the Australian market that we're working together. But you haven't really had an opportunity to sort of talk about your firm and the background to the firm. But I might ask you, Bob, just to say a few things about the firm, and you're based in Perth and WA. So over to you.
Sure. Thanks, Simon. Yes. So I've, with my business partner, Paul Coburn, formed Auxilium Partners in 2015. My background is in insolvency is through Ferrier Hodgson back in the day when I used to work with the Perth office, Gary Trevor, Alton Fox and Martin Jones. And then I progressed on there to open an office in India. So I had a Ferrier Hodgson office in Mumbai for 4 years. And out of that, I got interested in forensic accounting side of things. I was doing a lot of due diligence for private equity guys and distressed funds over there. And then ultimately we decided to form Auxilium Partners, which is going really well at the moment. We had a bit of hiccup during the COVID, but now it's all good. So mostly I just do corporate insolvency, restructuring, safe harbour, and a small business restructuring, which is the new legislation that came out of the COVID pandemic. And we also do forensic accounting. Our forensic accounting practice is quite big, and we're getting quite a bit of kudos from the work that Paul Coburn does with his background as an auditor. And we just recently completed a review into one of the Indigenous organisations, which has just released its report, the Kimberley Lands Council. So that's a really good job for us. And yes, so we're looking forward to our association with you, Simon, and going forward, in a sort of a agreement that hopefully we can start working together on some matters in the East Coast as the Australian market starts to get better for us insolvency practitioners, not for everyone else.
Yeah, look, I mean, that's right, Bob. I mean, the reason why we formed this alliance is that we do see and feel like there will be a pickup in insolvency, and the need to have that national presence is important. But over to Luke. Luke, Singapore, you're based out of Singapore. You've got an Australian accent, working for Quantuma. So it's good to see the Aussies are taking over the insolvency world. But tell me a bit about yourself.
Yeah, we're well represented in this part of the world. I started out in Bob's neck of the woods, actually in Perth, and then took the long way around Australia and worked in Melbourne for a little while, Sydney for a while, and then from Sydney up to Singapore. So I've been up in Singapore for about the last 10 years.
Okay.
Have spent the last 10 years here primarily in the restructuring space, and that's driven a lot. There's a lot of structures that come through Singapore, but insolvency in places like Indonesia, Thailand, Vietnam, Cambodia isn't really an effective, avenue for people to either recover value or to restructure a business. So we are primarily doing restructurings and have been doing that for about the last 10 years up here. So I started up with one of the sort of key firms in the region, progressed around a little bit, had my own firm for a while, and then now, since early this year, have joined Quantuma as their head. So Quantuma, probably not that well known in the Australian market, and certainly weren't too well known in the Asian market. But internationally, they have what I've seen now is quite an attractive business. They spun out of another firm in the UK about 9 years ago. They were acquired by a listed entity in the UK. So they sit as a subsidiary of a listco, and that's given them the capital and the balance sheet to really go on this global acquisition and establishing businesses like the one I'm running here in Asia Pacific, and we've now got the same in the Caribbean. So Quantuma bought a business in the Caribbean, so we have Cayman and BVI offices. They did the same in Dubai. We service the Middle East out of Dubai. The same in Cyprus, and we cover Cyprus into Africa. And Mauritius as well. We have a Mauritius office which covers that part of the world. So there's other offices scattered throughout, but they're sort of the key offices that I interact with on a day-to-day basis, and it's positioned us quite well to remain very agile. We're still a boutique, but we're big enough to take on those large, complex jobs that require the right level of horsepower. But we leave a bit of that bureaucracy that we've all experienced in other firms behind, and we get on with delivering the job.
Yes, we never experienced anything like that. But so the Singapore market, it's an interesting market. The options that are there for companies in financial distress. Do you want to talk through a bit about what the market looks like from an insolvency perspective, and what tends to happen? Do we see more informal workouts? Do we see formal appointments? I think there's a debtor in possession model and a rescue finance stuff that doesn't really. Some of this stuff doesn't really exist in Australia.
Yeah, for sure. So I think, the Singapore has been really at the forefront in structuring tax and attracting tax benefits and attracting large companies to structure through Singapore. So a lot of cases that we see here and they're presented to us, they may have either been banked through Singapore or they've got holding companies through Singapore. But, a lot of the time the assets are not sitting here. And if the assets are in Singapore, it's a pretty small amount of the overall group assets. They will sit either within the region, so Indonesia, Thailand, Vietnam, Malaysia, or they will sit globally. So we've got cases now with assets, from Madagascar oil fields to, large operating assets in the Middle East, some with operations in Australia. So, but a lot of it comes to Singapore, and there is this initial nexus to Singapore. And Singapore has been really quite innovative and aggressive in making sure it is a place where it's attractive to come and restructure your business. So there is the restructuring option. There is a liquidation option here as well, and I'll cover that off very quickly. Liquidations here were very similar to liquidations in Australia. Right. There's a court appointed, there's a creditors voluntary, there's a members voluntary. They're pretty straightforward. The only nuance is it's usually over a holding company in Singapore, and you have to then, for example, you might take the liquidation in Singapore. You will then use that as the shareholder of a subsidiary in another jurisdiction, enforce that security, the shareholding, and change boards, and then take control of the underlying assets through that enforcement down the structure chain. So that would be the only difference, I'd say, very common here in Singapore and how we use a liquidation to take control of assets. But certainly Singapore has positioned itself very well to be a restructuring centre. And I think that's because of what you sort of alluded there, Simon. There are a couple of things in Singapore that aren't available in Australia. There are things available here, and they've taken, a lot of hints from the US regime, so the US Chapter 11. But I suppose the benefit is that this is in Singapore. It's probably a little bit quicker. It's a bit closer. It's on the right time zone, and it's also a hell of a lot cheaper than a Chapter 11. So Chapter 11 is still a good process for some companies, but Singapore offers this nice in-between that it's a very nimble system. It has a couple of key features. So one, I'd say, and we're talking, I actually just come from a meeting with a company here. One of the key things Singapore has is a worldwide moratorium on filing. So we can, as long as a company has nexus to Singapore, and the Singapore courts have jurisdiction to hear it, which there's a certain threshold you need to meet. Upon filing of what's called a Section 64 application in Singapore, which is the relevant section of our Act, the company will receive automatic protection from the courts, a moratorium. That runs for a 30-day period. in which the courts will assign a first hearing. But you can take an extraterritorial moratorium there, and you can protect all of the other group subsidiaries. So in this example that I'm working at the moment, we have subsidiaries in the US, an operating company in the US. And so filing that in Singapore, which is arguably cheaper and more efficient than doing it in the US Chapter 11, will go and get extraterritorial recognition. So that's one really key thing that a lot of people like about the Singapore regime. And that's only, any jurisdiction, I suppose, can offer that, and it's only as powerful as people are going to respect it. But because Singapore is such a big banking hub, most people have some connection through Singapore in terms of structures, bank, flow of funds, that it is a pretty powerful moratorium.
So, look, how would that impact on the Australian? Let's say there's a subsidiaries in different states of Australia, and then you want to go through that process through the Singapore courts. Do the Australian laws, do we recognise that? Or would you have to just do it through the shareholding and appoint administrators or the like?
Yeah, so if you had a Singapore holdco into Australia with Australian subs, just use a mining example because there's plenty of mining companies that follow that structure. If we filed the Singapore company up here and we had this extraterritorial moratorium, and you had an Australian supplier, mining contractor in Australia, we would take that recognition into Australia, or the worldwide moratorium into Australia, and we'd talk to the creditors there and say, you are now stayed from taking action against the company and its subsidiaries. And it would have a pretty powerful effect, assuming those contractors or creditors in the Australian market had some nexus and could respect the Singapore moratorium. I'll give you a slightly different example. We can have worldwide moratorium in Singapore, and we can go into a village in Vietnam, and the guy who there is a creditor doesn't give two hoots about Singapore and will continue to take action. So there has to be some form of level of connection and respect for that moratorium. But certainly with a market like Australia, the Singapore moratorium would be very effective.
Right.
You touched on it being more efficient than Chapter 11. Is it simply because there's less court processes and legal applications made, or court applications made? Is that the reason? Is because, when I interviewed the US practitioner earlier in the year, Chip, we talked about the prohibitive cost of Chapter 11, and even in certain states, it's much cheaper than it is in, say, New York. But the feeling I still got was that the access to a Chapter 11 is still very cost prohibitive. So it doesn't allow. It felt to me like if you're turning over less than $50 million a year, that you can't really access the Chapter 11. Now they'll dispute that, but I mean that was the feeling that came out of the interview. Is it more sort of user friendly for those that are, let's say, turning over $5 million a year, or is there some sort of small size of business before you start to think about that option?
Yeah, look, I think the US is very well established. They've got a lot of history in the Chapter 11, but coming with that are there's a lot of money in terms of advisors. There's a lot of reporting. The courts take from what I see from the outside, it's quite a heavy-handed approach to monitoring the conduct of the Chapter 11. So there is a lot of reporting obligations, and that costs money in the US. I think in Singapore there are reporting obligations. There's certainly, it's not open slather, take a moratorium and go and do what you want. But the Singapore judges are very experienced from my dealings with them, and they're also very commercial. And then you have the Singapore, ecosystem of lawyers and advisors that are probably a little bit more nimble in terms of some of the big, large US firms. So you can file, I've filed companies here with revenue of less than 5 million, and I've filed companies in Singapore with revenues of more than $1 billion. It's certainly not cost prohibitive to do it for those smaller companies. Initial filing fee for a relatively simple structure, you're looking at less than $50,000. So it's pretty okay in terms of access to that market. The US would be many multiples of that before you can even start a Chapter 11 process. So And the other side is Singapore. It's very quick, it's very efficient. The courts will hear you very quickly. You get in front of judges who are very experienced. Singapore has just retained one of the Chapter 11 bankruptcy judges out of the US, Judge Stonchi, who's from the Delaware bench, and he's come to Singapore to hear commercial matters in Singapore on an international restructuring stage. So, Singapore is really bringing in the best of different markets into here, but keeping it very accessible. And very quick. You can be in and out of the scheme quite quickly. You can in the US as well, arguably, but it's pretty quick here.
Yeah. The other option that you had there was rescue finance. That's something I don't think we have much access to, or it's in its infancy here. We might call it something else, but talk me through what that's about.
Yeah, so we've done this a few times here in Singapore now. It's relatively new under the new legislation here, which is called IRDA. And it works very similar to a Chapter 11 DIP financing, debtor in possession financing. So a company that is under this scheme process can apply to have what we call in Singapore rescue financing. Rescue financing is effectively just new money coming into the business through this restructuring process. But what we will do is we'll apply to the court to have it granted certain levels of priority. So in the event the restructuring fails, the company goes into liquidation, this rescue financing, can go from anywhere from being an unsecured loan into the company, or it can rank pari passu with the liquidator's costs. So you can go very senior in terms of in priority. And that works well because it opens up the market to distressed, investors who play in this special situations place. It also opens it up to existing creditors. So we actually did the first roll-up, and roll-up's a term common in the US, but we did the first one here in a process where I was the chief restructuring officer. We put in new money, so there was new money coming into the business, but that was from existing creditors. And those existing creditors were able to roll up or prime their existing claims and also take them up the priority rank with the new money. So their total exposure was then afforded a much higher priority in the event of a liquidation. So that was first time in Singapore. The judgment came out. It was a very sort of detailed judgment to give guidance for future ones. But that's a very attractive part, sort of on top of just rescue financing. So when you have a company come back into why would you file, or what do we see in Singapore? It's quick, it's efficient, but you also have access to this. So once you push that button and you're into a restructuring, most of these companies are going to need capital. How are we going to make it more attractive for people, or at least get pricing that is sensible and tolerable? We can do this. So particularly as companies with assets, we can take new security, we can prime other security, and we can come to the very top or just below the very top if it all falls apart. It's a very good, very attractive part, and Bob probably knows from his time there are plenty of distressed funds out there that like this space and are actively looking for these kind of investments.
Yes, they are. When I was in India, they were mainly out of Hong Kong. They were coming out. ADM Capital, one of them I was working with. You probably know those guys there. And that's all they're looking at, maybe a 30 to 40% return, but they had lots of logs in the fire, I think, trying to get the synergy with different companies. And the main deals they sort of did were in the 50 million plus deals. So I don't know whether we sort of have that process here in Australia. I think we just get stuck with, even if they're, like, say, let's say a $15 million company turning over, goes under in safe harbour, for example. The options are quite limited here. You just, you just try and find someone to take out the existing debt and do it that way. So it's interesting to listen to what you're saying. And but are there funds in Asia or in Singapore that would look at something? I'm working on one at the moment that's in safe harbour, and they're struggling to fund out of a $30 million debt, and the secure creditor wants to stay in there, but they just can't raise any more capital. They're just struggling a bit. So I'm just wondering whether there's opportunities like that out of the Asian market?
Yeah, plenty. There's plenty of funds that I used to always refer to them as Hong Kong-based funds, but with recent events, a lot of those guys have come down to my neck of the woods and are now my neighbours. But those Asian-based funds, call them boutique funds. So they sort of sit between the behemoths and the very small guys, and they're investing anywhere from probably $10 to $50 million in these kind of situations. So, and there is a big appetite for it. I think a lot of those kind of investors like the idea of a Singapore process with a Singapore approval of rescue financing, because they know if it all goes the wrong way, they're in a jurisdiction that is very transparent and they can enforce their rights. And it's a nice structure to come in and jump the queue a little bit. So one of the things we see often there, Bob, is those guys might come in and buy up some existing debt, and they might use that to then prime and do the roll-up, which I've just talked about, which will just give them that extra buffer if things go wrong.
The law of safe harbour in Australia, Luke, is there something similar over in Singapore?
There's not really, from what I understand on safe harbour. There's not really that here. I think what we would do here is the scheme process is really what that's used for. So we'll file the initial moratorium. That gives some time to explore options. But you can't really go into that process unless you have a reasonably strong conviction that there is a restructuring to be had. So there is there's no equivalent to a safe harbour, but I think a scheme is probably one of those. A scheme you can withdraw and you can go back to I suppose, normal business. But it's probably the most effective tool up here to push the pause button, give the directors some protection, try and figure out what the options look like.
Yeah. I mean, the safe harbour came here in 2017 and it had a pretty slow start. There was a couple of firms, and there's a few firms here that have got a real name for themselves for doing it, but I've certainly seen in the last 2 years a real pickup in safe harbour work, and I think that's quite a consistent thing across the market. I mean, Bob, you're talking about one that you're doing at the moment, but what was interesting when the law first came in, it was a little vague and people were just a bit unsure what it would actually achieve, and I think it's sort of evolved itself because the law was quite I don't know if it's simple, but quite flexible in the sense that it wasn't stuck to a strict timetable like a voluntary administration. It wasn't public, which is something that's always an issue for insolvency restructures, in the sense that everyone knows about it, and does the actual business that comes through into a docker survive and continue to thrive when they've had so much brand damage done to it through the voluntary administration process. So, the ones I've done, the framework of protecting the directors from insolvent trading, there's the reporting function and there's the meetings that we have. But then the real actual implementation of initiatives is sort of in my view sort of jumps into that sort of chief restructuring role. And I know you're doing a few of them, Luke. So in some ways, if we pivot into that chief restructuring officer role, that's something that's probably a lot more popular in Singapore than maybe it is in Australia. But could that be the closest thing to safe harbour that over there, or you still think the scheme is probably the closer comparison?
No, look, it probably is, and I think if we do, and certainly myself do a fair few of those CRO appointments, both here and in other jurisdictions. And I think the directors that we're talking to and we're coming in and acting for, when they're concerned around things like insolvent trading, and Singapore has very similar rules around insolvent trading on their directors as Australia does, by bringing us in to really understand the business, come up with options, we would typically come in with counsel next to us to make sure we're looking at everything. It's not a formal system like safe harbour. There's no formal process around it, but it is a fairly good mechanism in which the directors can feel a bit more comfortable that they are discharging their duties properly and bringing in people, and we're monitoring to make sure things are going the right way and independent and not attached. If it needs to go into a process because of one reason or the other, we will put it in. So sometimes when we come in this CRO role, in fact, most of the time, in to make sure we are protecting the director's interest, we will come in with fairly broad authority. So one that we've literally just signed up this week. The board passes a resolution that empowers me to do anything necessary to restructure the company. So really, myself, I can make the decision to file the company into a scheme, and it's a big trust to me from the board. But it also helps them manage their liability that an expert is in. If I can't see a way out of this, I'm going to take the right action to make sure stakeholders, in particular in that situation, the creditor's interests are protected. So we come in with very broad powers. Hopefully, we don't need to use all those powers, but they're there for those kind of reasons.
Yeah, that's a huge amount of responsibility and power. Like it's if you can file on the scheme, that's almost like you're a director. You're in there and you're the board, and so do you often in those engagements have to undertake a restructure of the board and management as the first step? Or has that already happened? Or
No, we would. I mean, so on that point, we would often go in as a director as well. So we would chief restructuring officer would take an executive appointment as a director. Right. We will sit on the board, so we're in the trenches with the company, and we all have commonly aligned interests here to get through this together. But sometimes when we come in, we will restructure the management as well. That can be the first step. So, I've been involved where we've replaced CEOs before, and we've either brought in somebody from the business to be the new CEO, or we've brought in people from outside the business to, which have technical expertise to run the business. We've replaced chairman multiple times. I brought in other restructuring professionals to act as a chairman of a publicly listed board where we will sit on and try and restructure. So we have, a second level of oversight and guidance for us by having a peer looking and helping work with it as well. And, often we'll get in there and we might restructure the finance department. That might involve either putting the CFO to the side, or we might bring a new CFO in. We might, depending on what it is. Sometimes CFO can be very good, but when you get into a crisis situation, not a lot of people are that familiar with dealing with how do you manage cash flow down to a granular detail, and you're dealing with angry stakeholders. So we will then either plug it in ourselves. So one of my team might go in as an interim CFO, or again, we'll tap the market. We have a pretty good network of people that can operate in the space.
Yeah, that's a very interesting comment, Luke, because I'm facing that right at the moment, because the CFO at the moment, very good, but never had to deal with this scenario where you actually have to speak to creditors or say, you got to just hang in there while we're recasting the budgets or the cash flow or whatever. So different mindset, I think, from insolvency practitioners who actually go in there and we do things. And we crisis manage, basically, that's what we do. And we can handle it, but people who have never had exposure to that find it very difficult to come to terms with it.
We certainly don't have the kind of powers that you're getting under the same regime. We still are somewhat at the mercy of the board, but the board's the ones that ultimately are exposed to insolvent trading risk. And so if they're ignoring the advisor and the worst scenario was to happen that way, he went into liquidation, then naturally they would test the safe harbour advisor on whether they undertook and accepted the advice. Just changing a little bit now into the current market in Singapore. So we've come out of, I suppose Singapore's still coming out of COVID, isn't it? It's a bit stricter over there, but the market is somewhat normalised now from the extraordinary things that happened in the last couple of years. What's the market like financially at the moment? Is it a strong position, or are you seeing a pickup in insolvency and restructurings?
Yeah, we were under pretty strict conditions on as everyone was for a while, but then I think Singapore sort of threw that out all at once, and we went back to normal life pretty quickly. So, but certainly during COVID, the Singapore government offered a lot of support, particularly to local businesses, but there was a lot of support to international businesses here as well. So, not dissimilar to Australia and the UK and other jurisdictions. So there was, I think, when it started, I think people like us thought there was going to be this massive inflow of new work, and there wasn't, because the governments were able to keep people afloat for a while. But what we're seeing now, sort of, we're coming out of the back of that, the assistance from the government in Singapore and also the other jurisdictions around Singapore that we deal with have finished. And I think you're now sort of starting to see some of those problem companies float to the top. I think during COVID, there was a number of companies that did, what I would call, a defensive restructure quite intelligently and smartly. They did that early. They came in, they took, advantage, for want of a better word, of the situation and positioned themselves well. And they're the guys that are coming out now, and they're the people we're talking to about acquiring companies. But I'll put that in the minority. What I think we're seeing now is people are coming out of COVID. They've survived through, abnormal income from government or, reduced expenditure. That's all finished now. And there's this working capital crisis that they're facing that they haven't planned for. Yeah. So we're definitely seeing an increase in liquidation work. So it's gone past the possibility of a restructuring. We do quite a lot of work with various venture capital funds that I think have not had the insight to some of these portfolio companies through COVID, or perhaps haven't had accurate reporting. Now that borders are open and people are travelling, and these are operating in jurisdictions like Vietnam and Thailand, I think in those kind of cases, the VC managers are going down, having a look at it, and opening up Jack in the Box and realising that things aren't so peachy, and then coming to guys like us, and it's past a restructure, it's into liquidation. So we've seen definitely an uptick in that. And the other thing I think we've seen here in recent months, probably over the last 6 months, is an increase in forensic related work. So similar situation, portfolio or subsidiary companies, or just borrowers from funds or banks in different jurisdictions where they've basically had their doors closed for a little while. I think people have gone in now and started kicking the tires and realised that things maybe not have been done like they should have been done. There's been lots of fraud allegations. We've had a lot of dissipation of assets. So we have a specialist team. It's not necessarily my expertise, but we have specialist teams within Quantuma who have been engaged a lot in asset tracing and dissipation of assets. So there's a definite uptick in that we've seen, and I think that usually ends in either a liquidation, restructuring, some form of transaction that gets rid of the old and sets the business for the new, because sometimes that can be quite catastrophic if that kind of stuff's happened. So we're definitely seeing an uptick of that. So I think if you asked me, where's my crystal ball, what do we look like for the next 12 years? If the last 2 months is anything to go by, we need to start recruiting very fast because there is more work than I've seen probably in the last couple of years. It's good in that there is quite a bit of restructuring work. So there are companies, boards, sponsors and shareholder groups that are coming forward saying we need to restructure, which is always nice. But, there are still lots of those companies coming forward that are, facing liquidation. So I think the economy in Singapore is quite strong, but a lot of these other regional economies, their currencies are getting smashed by the US dollar, which is just hurting their margins. There's everyone knows there's massive manpower issues. There's logistical issues. In places like Malaysia, there's political uncertainty. Thailand has massive political instability. Same with Myanmar. And I think what that's doing is just the uncertainty increases work for guys like you and me. So I think we've got a lot of work in the next few years.
Yeah. Well, Bob, obviously in Perth, it was very quiet there during the COVID period, and now it's starting to come back. Is that what you're seeing in your market, Bob?
Yes, we're saying, well, we were extremely quiet, even quieter than the East Coast during that time. The pickup hasn't been as huge as the eastern states. I think we're saying it's getting, we're getting a lot more busier, and the practitioners here are also getting busier with work, but we haven't seen a waterfall of insolvencies coming through the Perth courts. I think the tax office is the main instigator at the moment, and what I'm seeing is a very slow. I think we talked about small business restructuring and a very slow uptake on that by directors and even accountants and that are working with the directors and their clients to go through that process. It's a much simpler process, Luke. I don't know whether you know a little bit about it or not, but it's just a process that's finished off in about a month's time, and you don't get that full-on administration type of regime. And the tax office, from my experience, I've done a few, and from my experience, the tax office is very easily convinced to take cents in the dollar. And we just did one recently that took 13 cents in the dollar on about a $200,000 tax debt. So, which is a big kick for the small business that we're dealing with, because you get rid of that debt and you can actually move forward in a way better than entering into some sort of payment plan where you're paying off 200 grand over 5 years. You'll never actually get to it. But the formal stuff is coming through. There's companies are looking at doing administrations. So like prior to sort of, I don't think it's reached the stage where it's actually gone to the pre-COVID scenario. I think we're still lagging behind the East Coast. So we're hanging in there. I think our economy is a little bit stronger, and but we'll get there. I think eventually.
Well, we've got mining, I suppose, and I think we're putting solar panels over a third of Northern Territory to power Singapore, I think, Luke. We do have an advantage. We do have a lot of land and a very small population, so it's got to work in our favour. But yeah, look, it's good, gents, and it was really good to catch up. At the moment in Australia, the eastern seaboard, and I'd probably point out New South Wales more so than Queensland and Victoria. We're seeing more insolvency come in. Most of it is tax arrears and lease arrears. We saw a good pickup in August, September. October sort of plateaued a little bit. It's interesting. We're seeing a very healthy return to the federal budget. We saw a $50 billion improvement to the budget, which is pretty much off the back of mining, I think, and we'll possibly benefit from a low US dollar potentially, but. The global inflation is something that I think will be something that we're at the mercy of, and will be subject to, similar to what you're saying, Luke, around the strong US dollar, energy crisis with Russia. That I'm sort of in two minds about that. I think that's going to work in our favour. We've got the resources to fill the gap that is missing in Europe. But we are going to see a real pickup in energy. I think the other day we read that the cost of energy might jump by 35%, whether that was just New South Wales or other parts of Australia. It's consistent with some of the electricity retailers collapsing in the last few months, not to the extent that the UK was having, but look, other than that, it was great to catch up. It's good to get some insights around what we're seeing in other parts of the world. The Asian region is obviously an important part to our country, and what happens there has an impact on us. But thanks, Luke. Thanks for joining us, and Bob, my guest co-host, thanks for coming on. You didn't do too bad there, Bob. You're right. Quite a natural, but thanks a lot for that, and thank you everyone that's tuned in to listen to this episode of The Cut. You've got a perspective on the Asian and particularly the Singapore market and what they see there. For us, Singapore has always been quite commercial in the way they draft their legislation, and we've always looked to them as being one of the front runners of approaching insolvency with a lot of common sense. We've got a full-blown insolvency review about to kick off in this country. It will be interesting to see what we do. We haven't had too much luck in previous reviews where common sense has been applied, and a lot of things have gone missing. So we're all hoping that a lot more thorough investigations and submissions and acknowledgements of changes that need to happen to make our restructures a bit more effective, and in rescue finance, debtor in possession. We're hoping that's going to be part of that process as well.
Right.
But thank you, Luke. Thanks for joining the podcast. And
Thanks, Simon.
Thank you both.
Thanks,
Thanks, Simon. Thanks,
Take
Bob.
care. All right. See you later.
Cheers.
Bye-bye.
Bye.